Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day. Ira Epstein of Linn & Associates with your financial market wrap-up for this end of trading on Monday, the 1st of August, 2017. We're just after 4:30 p.m. Central Daylight Time. So as you take a look at the energies, you can see they got hit, and what happened there is the API numbers came out, and while you got a nice draw in gasoline and distillates, you got a build of nearly 2.5 million barrels in the crude, and you saw a build in Cushing, Oklahoma of 2.6 million barrels. So the market's going to take that initially as bearish. It can all change, of course, if the EIA report in the morning comes in and shows a draw. But if it shows a build also, that's not going to be good, and the market will be even more bearish on that. In the stock market, Apple's earnings came out after the close, and I think that they looked pretty darn good. They were a dime better than thought, and forward guidance is calling for September. The trade was looking for about $49 billion. Now they're talking $49 to $52 billion. And if that is, in fact, the case, what it means is that when the release typically comes out of the new iPhone, part of that's in September. That would account for that other $3 billion. So we'll see if I'm right or wrong on that, but I think that's how the trade is going to interpret everything. While the gold finished up $6, it was nowhere near that. It was lower than that going into the final end of the day. And the dollar index, a small gain. So where these markets are right now, I think, is they're getting themselves prepared for Friday's employment data. And off that employment data, you're either going to get a piece of data that says, hey, the Fed could come back in and do something, or as the current Fed Watch numbers show. So if you go to the CME group, they have a Fed Watch page. Currently, the September probability of a rate increase is 1.4%. You heard me, 1.4%, practically no chance of it. And by the end of the year, only a 46% chance, which means 54% chance it won't happen. Those are all things you got to take into account, and a lot of that will get answered as we get into the data come Friday on the employment numbers. Now on the NASDAQ, as I said, this market could get a pop off the Apple numbers, and I don't take Apple to be a bellwether for the whole tech sector because of what it does. It's a tech company, but it's a phone company. I mean, you got to look at what they're doing as they're trying to branch out here, and they're a marketing company with their website and all the apps they sell. But as you take a look, the market is backed off from that high, still about 30 points, nothing big going on. When you come to the daily chart, you can see how this action, you had an inside trading day today. Now here's what's interesting. The market right now has a pattern of lower highs and lower lows. If the market takes out 59.33.5, what happens is you will shift that, if you don't take out 58.50, to higher lows and then a higher high, actually turning the market instantly bullish. So what the bears have to do is not let it get through that number if they want to maintain the bearishness. On the other hand, because the market is over the 18-day average of closes, being bearish is hard. So the easier path, if the market's going to do anything, is taking out this 59.33.5 and trying the upside again as a probe. That doesn't mean they'll do it. I'm just telling you where they're at. If the market breaks down, because it did lose an embedded reading the other day, well, then 58, 55, 75, the 18-day average of closes is still very much in play. And as you can see now, you're bringing in the Bollinger Band bottom and top. So they're wrapping their arms now around the market as we get in front of Friday. We have to wait, obviously, and see how this gets impacted by the Apple news. And this is the loss of that embedded reading. The momentum is still overbought, so it's very hard to get bullish a market, even if it gets through 59.33.50 for a lot of disciplined traders, when you have momentum pointing down and yet price could be pointing up. Going to be a hard trade tomorrow in that market. In the S&P, you held on to your embedded reading, just by the hair of your chinny chin chin, but you did it. And as long as that's going to hold on, this market still has upside momentum in place, and it could still target 24.93. In the Dow Jones, the watch, if you will, is on. The news headlines already got 22,000 pegged in. Why not? And as you can see, the market's got a fully embedded reading. It is riding the upper Bollinger Band. I don't see anything bearish on this chart whatsoever. When we come to the Russell's fighting a battle right now at this 18-day average of closes. The market has had the bulls on the run. In fact, it turned into a downtrend with lower highs and lower lows, but it's refusing to follow through. And that's problematic for those of us that might have been in the bear camp because of the chart reading. If you should take out 1433.40, be careful, because you will then have a pattern of a lower low and a higher high, and you will be fighting the market in several different ways. Who's winning the battle right now? Plain English, the bears. And they have to defend the position into this 18-day average of 1429.40 and not let the market get over that number. The bears are still in control here. And guess where the VIX went after hitting that 18-day average, I'm sorry, the 100-day average of closes. Now, 3 days in a row, basically, down, running that 18-day average of closes. Momentum is up. The trend is not up. I had it up until it lost this part of it today. It was an inside day, so I'm really wrong on that. We should have a market with a down line here and this up line there. There is no trend. You have a lower low and a higher high. There is nothing to do there. In the T-bonds, you went into the bull mode. The market now has higher lows, higher highs. I say the trend traders will be buyers at 153.3. They won't want the trade to get under the lows back here. This is an outside day up, so today's low of 152.9 is going to be a key number for them. If the market rallies and momentum is up and bias is up, 154.26 is in play there. What could make that happen? Well, certainly poorer job or employment data. That could be a catalyst. 10-year notes, outside day up. So far in bonds and notes, you don't want to see today's lows taken out. But unlike the bonds, this market's already in overbought territory. Yes, it is targeting the potential for the 126.18 area, but getting back under today's low in bonds and or notes would spell a bull trap and can send the markets down to the supports right under these numbers. In the SEP dollar index, you still have a completely embedded stochastic reading. So this market's fully bearish. Lower highs, lower lows, embedded reading under the 18-day average. Other than a bounce, I don't see any change in sight here. And it's the flip-flop on the euro. Bullish as can be, higher lows, higher highs. You're in the 118.31 level. Yeah, you can get a correction at any time, but there's nothing on this chart even calling for it. By the way, for those of you that like the SEP Aussie, I don't know if you're aware, but if you're in Australia, I am on Sky Biz there every single Tuesday at Chicago time, 3:15 p.m. So I've had a standing show on Sky Business there for a very long time, and we talk about what the currency values are. I'm cautious right here. The market acts like a market that wants to pull back. It's flirting with losing its embedded reading. It only kept it by 0.2 of a point there, and when it reopens the way the math works, it probably is going to lose that reading temporarily. This is a market that needs to start going up again, otherwise a correction could be in the cards. Japanese yen, an embedded reading. It is saying it wants to ride, get up to that upper Bollinger Band. Now, it doesn't have an easy time getting there. Notice it did it once and it came back, and it's been unable to do it, but it's kept a very bullish bias and no reason not to stay with that. In the crude, it's going to be an interesting what-if scenario tomorrow. And the reason I say that is, at the close of business today, you still have your embedded reading bullish. The market's got a pattern of a higher high but a lower low, not trending there. You need to get back over today's highs to keep the bullish momentum going, because you had a key reversal outside day down. In other words, the highest high of the move, big reversal down, not pretty. First stopping spot, as you'd expect, the 100-day average. If it falls from there, then it becomes the 18-day average for the support. In the gasoline market, same thing. Outside day down, but also a key reversal day down. Now, do I put a lot of stock in that? Not as much as you might think when you have embedded readings. This is still in the hierarchy of the way that I teach charting, the number. Also, Look at how you are. You're going to get a crossover here that could be bullish where the 18-day gets over the 100-day. So I think we're at very, very important numbers, and they're going to carry a heck of a lot of risk with them tomorrow into that EIA set of numbers. When you look at the nat gas, I am not surprised to see a bounce. The odds of staying under a Bollinger Band are initially 5%, and successive days even lower that number. You closed under it yesterday, you bounced right back over it today. Oversold in a downtrend. The market is still looking weak. I'm writing my gold report, and I might have it through tomorrow. If I do, you'll hear that I'm going to release it. It is not automatically sent to everybody. So if you want a copy, you got to let my staff know. And this report, the last one I did was June 17th. I did one based on long-term looking at gold. This one's going to look at the short-term looking at gold. What to expect in, if you will, between now and the end of this year. What to look at in the upcoming quarter. I can already tell you I've done a lot of seasonal work. What happens between right now and October is going to be very, very important in the market. And I discussed it all there. So you can sign up for it on our website. You can go to any of our things. If you sign up for our Investors Kit, that'll be included. Best way to get this is calling my staff. You can click up here. If you see me on YouTube, click on that icon. Our forums will appear. And underneath us on many websites says, click here for Ira Epstein's free offerings. Do that, and away you go. I'm Ira. You have a good day, and I'll see you all tomorrow.